So, just a few days ago, something pretty big happened in the world of finance, something that hasn't happened in nearly 2 decades. S&P Global went and upgraded India's sovereign credit rating. Okay, so let's jump right in and break down what that actually means. Yeah, you heard that right. 18 years. To give you some perspective, the last time India got an upgrade like this from S&P was way back in 2007. So for almost 20 years, through all kinds of massive global shifts and economic changes, this rating has been completely frozen until now. So what exactly happened? The official change was a move from a BBB minus rating up to just BBB. Now, I know what you're probably thinking. A minus sign vanished. Big deal, right? Well, let me tell you, in the world of global finance, this is a huge deal. But before we get into the why it happened now, after all this time, we've got to cover the basics. What even is a sovereign credit rating? And more importantly, how does it actually affect a country and, its people? So let's start at the beginning. People often call this a nation's financial report card, so let's see what exactly it's grading. At its core, a sovereign credit rating is exactly that, a report card on a government's ability to pay back its loans. Because let's be real, running a country is incredibly expensive, and taxes don't always cover all the bills. So governments borrow money. They do this by issuing bonds, which are basically IOUs to global investors. This rating tells those investors how likely it is that they'll actually get their money back. And the folks writing this report card? Well, it's a very small and an incredibly powerful club. You've got S&P, Moody's, and Fitch. Between the three of them, they control about 95% of all credit ratings in the entire world. So yeah, when one of them speaks, the entire financial world listens. Now, to really grasp the gravity of this, you have to look at the scale. AAA is the gold standard, the straight A student. India's old rating, BBB minus, was the absolute lowest possible investment grade. It was literally teetering on the edge of being considered junk. So this upgrade to BBB moved India a crucial step away from that cliff, putting it more comfortably in the safe zone for investors. So, here's the bottom line. Why does this matter to you? Well, a better rating boosts investor confidence. This can lead to billions of dollars flowing into the country from big global funds. More investment means the government can borrow money more cheaply, which frees up funds for things like infrastructure and public services, and that ultimately helps give the whole economy a boost. All right, now that we have the fundamentals down, we can get to the main event, the real mystery at the heart of this 18-year-long standoff. Why the 18-year wait? And what finally changed that made S&P give India the nod? Well, the short answer is, it all comes down to the country's fiscal health. To find the answer, we have to follow the evidence. So let's unpack the key numbers that S&P has been scrutinizing for nearly 2 whole decades. For a long, long time, India's public debt, the money the government owes, has been the #1 concern. It was already hovering around 80% of the entire economy's size back in the 2000s, and then it spiked to nearly 90% during the pandemic. While the recent dip to 83% is definitely an improvement, that number is still very high. The problem becomes crystal clear when you compare India to its peers. For other emerging economies, the average debt is much lower, closer to 60% of GDP. That huge gap has been the single biggest reason rating agencies were so hesitant to upgrade for so many years. And to put that percentage into perspective, the raw number is just staggering. The central government's debt alone stands at 197 lakh crores. That figure has nearly doubled in just 7 years, acting like a massive anchor on the country's fiscal health. But, and this is a really big but, here's the other side of the coin, and it's the reason for the upgrade. Despite that heavy debt, India's economy has been growing at a powerful and steady 6.5%, one of the best rates in the world. It's this robust growth that ultimately makes that big debt load seem a lot more manageable. So you could say S&P had a checklist. They weren't looking for just a short burst of good news. They wanted to see long-term, sustained progress. They wanted to see better government finances, rising tax collections, real structural reforms, and inflation under control. And after 18 years, they finally feel that India is showing enough consistent progress on these fronts to justify the upgrade. So the upgrade is in the bag. But this story isn't over. Not by a long shot. In fact, S&P has made it very, very clear what needs to happen to keep this momentum going. And here's the catch. S&P dangled the possibility of another upgrade, but it comes with a very tough condition. The government's deficit, That's the gap between its spending and its income, needs to consistently fall below 6% of GDP. And that's the big question for the future, isn't it? Can India actually hit this very ambitious target? And here is the core challenge. The target for another upgrade is a deficit below 6% of GDP. But S&P's own projections suggest India will only reach about 6.6% by 2030. It's close, but it's not quite there, which means the path ahead is going to be difficult. So, what should we take away from all this? Is this upgrade a vote of confidence, or is it more like a warning for the future? In the end, it's really both. This is a clear vote of confidence in India's economic management. But it's also a clear warning. The progress is real, but the expectations are now higher than ever. Whether this becomes a launch pad for further success or a high watermark, well, that's something we'll all have to watch.